Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew Meredith, welcome to, it's 9:48, but welcome to Noosa.
Thank you. Good to be here.
Yeah, it's great, mate. We're recording October 10th, Monday, because we're in Noosa for the Inside Network event.
And beautiful weather out there.
It's wonderful. If you're watching on the video, you can see lots of grey clouds and
torrential rain.
Torrential rain. When I pulled up in the plane, sounds like it's my plane. It wasn't. It was just like I was in there with about 500 kids. But when I just landed, it was just bucketing down.
Yeah.
Like unbelievable.
Just more time to learn, I think, is the key to that.
You know, what I did on the plane is I actually wrote up my thesis on Dubba while I was on the plane. I saved all the annual reports, read them, and then wrote that up because I knew I wouldn't have any
for Warren Buffett on the way here.
That's it, yeah. Yeah, I'm going back and reading somewhere over there, The Making of an American Capitalist. Have you read that book?
No, I haven't had that.
That's good. It's really good. Yeah. It talks about, because it's like it talks about like his journey after the Depression era, learning from Ben Graham. And like a lot of people talking about recessions and high inflation and all that sort of stuff now. But if you just read about his journey, you just follow it. Like, and you just see it. The stuff just plays out.
Yeah.
Yeah.
Finding cigar butts and...
Yeah. We're recording 9 podcasts today. I think it's the world record.
So short. We usually go over time, so I'm not sure. We've got 8 hours to record 9. We probably need 15 hours.
Yeah. We'll probably be here at midnight. So guys, yeah. No, but we are here for the Inside Network event. We are surrounded by lots of consultants, portfolio construction experts, advisors, some of the best advisors in the country. So hopefully we can get them even for 20 minutes in here to talk with us. And they'll appear on the Australian Investors podcast as like more short form episodes. So yeah, we're going to talk a bit today about, we're going to do a 2 cents episode. We're going to answer some questions, a lot of questions sent in, kind of a medley. We've got questions about lithium, of course. We've got questions about...
All of them are about lithium, aren't they?
Yeah, to some way, everything ties back to lithium. It's like Bitcoin before it. No, and then we've got questions about equal weight versus non-equal weight tracking error, which we might riff on a little bit. And yeah, some really good questions. If you do have questions for Drew or I, or even on the business podcast, the finance podcast with Kate and I, please just send them through. Head to any of the Rask websites. There's a thing at the top in the menu that says ask a question. Pretty straightforward. Just click that button. I get a lot of questions coming through Twitter, Instagram, etc. Please just send them through there so we can keep on top of them and we can get your question answered. We will answer questions today. We've asked for funny names. It's a bit of a lighthearted take, this episode that we do basically weekly now. Just remember, it's general advice only. We don't know your personal circumstances. If you do want to see a financial planner, just like Drew here, you can head to the Wattle Partners website or find your financial planner near you using one of the ASIC website or whatever works for you. But because we just don't know his personal situation. So Kate, Drew, I said Kate. Let's go with Drew. Let's answer some questions. So I grouped the first 2 questions together. Maybe we'll just take them both, together.
Definitely.
Bang Goes asks, future of EV, go all in on lithium companies whilst shares are still low, or branch out and spread portfolio over multiple other minerals companies that make up a battery, i.e. nickel, cobalt, etc. Second question related to this, if you thought that one was good, from Nate. Nate says, I've just started investing. Had a quick...
Well done.
Well done. Great. Yeah, no, it's awesome. Nate, the first part is the hardest.
Yes, definitely.
Yep. Had a quick conversation with a day trader who was telling me about Sayona Mining, a lithium company. He just wanted to know your opinion on the lithium sector and your thoughts on it and how it might perform in the long run with mass introduction of lithium-powered cars. Drew?
Tough one first up.
Yeah.
I mean, I think the first question, you have to assume that the first question they're talking about a portion of their portfolio. So when someone says go all in on lithium companies, I assume that means, 5% of my equity allocation, I'm just going lithium. So generally don't go all in on a single commodity or even commodities in general.
Yep.
It would be the first starting point. And then, lithium and batteries, it's so, I think they've said there that it's quite low at the moment. Well, I think the sector's been on an exceptional run for the last few years. So I find it incredibly difficult to understand what the outlook and the long-term, what the long-term price looks like. It seems like every single time at the moment, prices are going up, lithium companies are going up, but there seem to be more companies mining lithium than ever. And I think apparently it's one of the most abundant resources. It's just very difficult to process. So commodities tend to be cyclical. High prices breed more production, breeds lower prices. So I'm always wary. I'd say if this is an allocation within an equity within an equity portfolio, then look at some of the other commodities as well. The cobalts, the nickels, because technology moves pretty quickly. So we might have non-lithium batteries or less lithium going into batteries as well.
Yeah, I hear. I agree. I think we had a lot of questions on this a few weeks ago. Start at the ETF level and work your way down is what I would say.
Definitely.
And if you did that, I think you'd find that Sayona Mining, while it has gone up pretty strongly recently, it's probably less impressive than Pilbara Minerals, which is probably the standout pure play lithium company in Australia at the moment. We spoke in the office a little while ago about how that company's turned to free cash flow. And I think you have one of those, it's like Fortescue and iron ore. Then everyone follows and they're like, it could be the next Fortescue, it could be the next Pilbara. Go all in on lithium companies. Bang goes, don't know who you are, but please just remember that investing is a marathon, not a sprint.
And a lot can go wrong in mining too, which is particularly at the moment. Labour costs, energy costs, fuel costs, everything is going up at the same time that you're trying to sell your commodity at a high price.
I prefer, the thing about the AC/DC ETF from Global X, just so you know, is it doesn't just invest in lithium.
Yeah.
And I think that's actually a good structure because it removes the focus on mining, which Drew was mentioning, is cyclical, capital intensive. Like inside that ETF, when I looked recently, there were companies like Tesla, BMW, alongside businesses that focus on battery technologies.
Yeah.
So you get a lot more, and they call it a value chain. You get a lot more
supply chain.
Yeah. And I think that should be a first point of call. And still, even then, for me, one commodity, one sector, it's still got to be in that tactical kind of satellite allocation. It can't be in the...
small portion within an equity allocation.
Yeah. So please, Nate, great job starting investing. It's the hardest thing to do, especially now when the market's really volatile. Yeah. It actually is interesting. I think that's the best time to start because if you can do it now, you can handle it later on.
Well, I'm talking to clients this week with, difficult period in the last 3 months, but you think about where we were 18 months ago with bond yields next to zero, markets at all-time highs. Well, now you've got markets that are off 20 to 30% in most parts of the world, and you can get 4% from a government bond now.
Yeah.
It's actually a much better time to be deploying capital than 18 months ago. So
for sure it is. So great job starting, Nate. I would just say, Nate, one of the things you've got to learn when you're new in it as an investor is it's a very steep learning curve, and there's so much information coming at you very quickly. Take your time. Start as small as you possibly can. That's not specific to you, Nate. It's just specific to anyone that's starting because I feel like it's one of those things. They say in business, if you can survive the first 2 years, you're all right.
Yeah.
If you can survive the first 3 years in investing, I think you're going to do all right. It's just getting to that line. So start small, learn what you can, and also just understand who you're getting information from. If you're talking to a day trader, that's going to be totally different to the information that Drew and I espouse. So sure, have some exposure to lithium, I think is the conclusion, but not all in, however that's defined. This is a good question. It's more like ETF related, which is it's go long or go home, like it. When I look at the US listed IVV ETF, it seems to be more closely tracking the S&P 500 compared to the Australian listed IVV ETF. So obviously IVV ETF here in Australia is one of the biggest US focused stocks ETFs. True.
I think the reason, just looking at it, is that the Australian IVV is an unhedged version. So that means, if the US listed IVV is investing in US dollars, the Australian listed IVV is investing in Australian dollars into the same index. So there should be a difference. The Australian should have performed better than the US if you looked at them. If you compared the US IVV to IHVV, they should be nearly identical. But I know there's a slight fee difference. I think the US versions are something like 0.04%. Maybe the Australian version's 0.08 in terms of fees, but that wouldn't be much to...
I think it's, you're right. I think it's about 10 basis points.
Yeah.
All in. So at 0.1% for those of you playing along in English. There's quite a bit of difference. What we can also see, which go long and go home, this wasn't talked about here, but what can also happen is if you have an Australia domiciled fund investing into the US, that can bring up some issues with tracking error because the fund in Australia then has to invest in the US, and it could use derivatives, it could use different things to invest that money across. So,
and while the market's closed.
The market's closed, yeah. So you can miss out on a bit of that. Now, that said, it looks like the IVV ETF, up 41% over 5 years. The SPY ETF in the US, which is the S&P 500. Does it, we're probably splitting hairs a bit here, I would say. Does it, does this factor into your thinking? Like, you could go and get an exposure from, a US stock.
Yeah.
Or would you just buy the ASX listed thing?
If it's the S&P, I just buy the ASX listed.
Yeah.
Easier, less paperwork, reporting simple.
Yep.
Don't have to do any W8BEN forms.
Yes.
You have to do when you're investing overseas. So,
yep.
And you can easily hedge it and implement it during your daylight hours rather than having to trade it overnight or hope your trade goes through efficiently. I agree. Like there are two vehicles here in Australia that you can get exposure through. You've got IVV and you've got IHVV. IHVV being hedged, slightly more expensive. That basically just comes down to your view on currencies. And I probably wouldn't be basing that on short-term swings in currencies, but maybe longer-term views on that in particular. So great question, because tracking error, which is the difference between an index and an ETF, basically, is not talked about a lot, especially amongst newer investors. So ASX listed for me. Shri asks, and this is quite a long question, and it's a good one. What do you think about EML payments and Tyro as of today? These have been an investor favorite for a long time, and no matter how bad the dip was, they always bounce back. Currently, they're trading at 82 cents and $1.28. I think that's slightly different. And I have been buying the dip and accumulated some shares during the last few months. I am nervous and want to understand what you would do if you had these in your portfolio. P.S. Thank you for the awesome podcast. Smiley face. That's a great question. So, I'm happy to maybe just riff on this for a bit. So Tyro Payments does the electronic payments where you go and you tap your card. Like an iPad almost, isn't it?
That's Square. That's Square. Yeah. So they're kind of a bit chunkier, to be honest. To be honest, I think they're kind of ugly. So they're bigger Square, and you can put your...
Oh, like your hand.
Yeah, your hand can go inside it. Yeah, so someone doesn't steal your PIN or whatever.
Not that we use PINs anymore.
I don't think anyone uses PINs anymore. So that's what they do, and they collect a fee.
Yeah.
And then they clip the ticket as fees go through. And Tyro were hurt by two things over the past 5 years. One was the outage that they suffered. That was like a reputational thing. And the second thing was COVID. They do it basically, everything's in store.
A lot of merchants and cafes.
Yeah, that's it. Yeah,
it's their target market.
It's like that SME.
Yeah.
Small, medium enterprise.
Yeah.
SME. When I first heard that, I was like, what are they talking about? This is a very, very competitive market. And previously, I'd recommended Tyro to our members, and I sold it. The reason being is that in this space, you have a few players that are very unique. So you've got SmartPay, which is the small cap Kiwi company that's expanding to Australia. And its value prop is something called Smart Charge, where it passes all the fees back to the customer. So that surcharge thing, if you get this coffee here, it's like $4.50, you might add 5 cents onto it.
Yeah.
That goes back to the customer. That's SmartPay. Tyro can do that as well. The other thing that The other one that's in the space is a clear competitor is Square/Block. That's the iPad one you're thinking of. Yeah.
And the little
yeah. And that business, I think, to be honest, that's been absolutely smashed recently because Block in the US has buy now, pay later because they bought Afterpay.
Yeah.
Exposed to
crypto,
lower socioeconomic, typically through the Cash App. And they've got like the sellers getting crunched.
Yeah.
So I think that's a really interesting business, Sri. If you want to put that on your watch list, it's Block. SQ2 is the Australian ticker symbol. But I think what's happened with Tyro is it's kind of been sandwiched in the middle. It's kind of got like, I don't know it's kind of like in there. And I don't think the value proposition is that clear, particularly now that management seem so aggressive on spending. They came out not too long ago and said, we're going to keep spending and the business isn't profitable.
The barriers to entry aren't big either, are they?
No, that's the thing. So one of the things that we saw is like Visa and MasterCard have the power here.
Yeah.
So they increased fees.
They get paid regardless too.
Yeah, that's it. Yeah. So they increased fees very modestly, and Tyro during COVID didn't pass on that fee increase because they wanted to support their merchants. But I think and then they got whacked. Their margins got crunched. Yeah. And what happened was I think they still had, I could be wrong about this, between 10 and 11% churn, even though they didn't increase fees.
Yeah.
So the true cost of the true sign of a competitive advantage is keeping your customers while increasing prices.
Yeah. Pricing power.
Yeah, exactly. So if you can't increase prices and keep your customers, then it might be a bit of a tough place to be in. So
better than buy now, pay later, but
yeah. But slightly.
Yeah.
But there's a big talk about this on FinTwit lately that many of these payment companies may actually have no terminal value.
Yeah.
Because in 5 years, the industry is changing so fast. Do they actually have any value at the end? We don't know. So that's Tyro. I sold it. I sold it at a pretty bad time. It was on the way down. It's come back up a little bit. I don't think it's like going out of business or anything, but it's just one of those businesses that needs to do a bit of work on the cost side. Finally, EML. Basically, everything that could have gone wrong at EML seems to have gone wrong over the past 3 years.
Yeah.
Do you know much about
Legal, it? Yeah. This is the prepaid cards and transfers, and they bought a business in Ireland as well, and then that got in, not them, but the business they bought got into trouble.
Yeah. And then there are a few things recently, like fraud as well. Just as they were coming to the end of that and the Central Bank of Ireland investigation, then there was more fraud, basically at the same time as they were giving their annual results out. So,
and whenever you hear those things, you just make it simple, just get out.
Yeah. Well, it's interesting, right? Because
we did talk about my falling knives last time. And there's one lesson from that: just get out as soon as there's bad news.
So CEO basically, I don't know if he was ousted or he just removed himself, and he gave like 1 day's notice, it seems.
Yeah.
After 8 or 9 years, which is a bit of a shame. There's been some fines, some regulatory stuff. EML is a very complicated business to understand. And the new CEO comes from NASDAQ, is her background.
Yeah.
And she's currently conducting an annual review that will be due out during the AGM, I think in November.
Yeah.
So that's when investors will know a lot more about what's happened. And typically with these types of businesses that expand globally, there's like two types of CEOs. There's the one that comes in and grows it and just grows it and grows it. And then there's the one that comes in and cleans it up. Not to say that that's what needs to happen, but that's typically like the ebbs and flows of business. Like we're going to grow and then we're going to consolidate and we're going to simplify. And I think for the most part, that's what EML needs to do.
Just kind of bolted on a heap like a roll up.
Yeah.
With equity and cash.
Yep, exactly.
And then whether all those things work together, you promise synergies, and do they come together?
The one good thing for EML, was a couple, but one good thing is that it actually has the float of customer deposits.
Yep. And
that I think will run over $10 million annualized now. So that's just pure net income for them.
And now with interest rates higher, so it's like it's a little bit of an inflation hedge.
It's going to keep going as well.
You're taking that margin.
For a business that struggled to get that margin recently, that's a free kick for them.
Yeah.
So that's pretty good. But the thing that's hanging over their head is what happens in Europe with basically EML has to make good with the regulator so it can keep winning new customers that want to use its payments network. So I think for me, it's hold out until November till we know more about EML, but I'm not really convinced about Tyro. My preferred exposure is Block and Smart Pay for payments.
Struggle with small, mid-sized companies, isn't it? Where you have to trust what's in the annual report or that they're making the right due diligence when they're making acquisitions.
Yeah.
And then if it's wrong, the share price just moves significantly compared to, I mean, Block's probably the same, but large companies.
Now it's like small cap US.
Yeah.
I actually think that, oh God, I got these glasses off my head. Forgot I had them on there. So if you're watching the video, you know what I'm talking about. Drew's got his Tony Stark glasses. And we're in Hawaiian shirts. Probably should have made that clear from the outset. We thought it was going to be sunny here in Noosa. So we're like, okay, let's embrace it.
Feels warm.
And we're just a couple of fellas just walking around at an investment conference. So good question though. Great question. I'll provide an update, Sri, when we get to November. The next question is actually not a question. Confused by marketing.
Sounds more like a complaint.
Yeah, it was someone that was trying to join our service, and this has come through the questions line. They were like, is this $69 upfront plus $10 a month? No, it was $69 for lifetime access to our membership. So it's like forever. And the new fee is $10 a month, $9.99. So if you want to become a Rask member, thanks for the free plug. They're confused by marketing. If you want to become a Rask member, it's $10 a month, and you get research on ETFs. You can join the community. We do live shows, and you get some company ideas from me. Thank you. Confused by marketing. Johannes Gutenberg. Is that... Drew, I'm not good with names.
Real name. It's a real name.
It's a real name.
Yeah.
Okay. This is interesting. A company that I have not heard of. Give me your hot take on IGL. I believe that's the ticker symbol. Mine, it's cheap, well managed, and now a monopoly player in the Australian printing space. Interesting. So IGL, hadn't heard of it as a business, to be honest with you. Seems like a business that basically does every type of kind of like digital, creative, print, creative, all around kind of like a business that is kind of like, you could say maybe old school type creative content, like marketing and publishing.
And like a My Deal kind of business as well, Lasso.
Yeah. So it's growing. The revenues have been growing pretty fast since 2014. $278 million up to $760 million in 2022. So it's compounding pretty quickly at the top line. In terms of gross profit margins, around about 26%, ebbing down to 23%. Operating margins is where it comes unstuck. Actually, it can, it's 5% operating margin. So this is a business, for the most part, I don't really know much about, Drew. 330 million market cap. What I would say is a business like this can sometimes be outside my circle of competence. There were a few businesses like this that did pamphlets and like the Dropbox. Is it Dropbox?
It's old-fashioned printing.
Yeah,
old-fashioned. Or new-fashioned printing.
Yeah. But really interesting business, and I'm going to actually look into it a bit more, and I don't know that much about it. Hannah, so if you do want to write into me again, just send us an email, would you? service@rask.com.au, and let me know a bit more about the business, because I was trying to find a bit more on it and I can't find a lot. Seems still too small for some analysts, but expectations amongst analysts is still pretty consistent growth, mid-single digits, EBIT margins slightly improving over the next couple of years. So don't know much about it, unfortunately, at this time. But maybe it's something that we can look into, because I don't mind old school businesses.
I tend to tilt toward the negative, if you haven't met me before.
Yeah.
Printing, I know it's getting more popular, like custom and that sort of printing, but at the same time, you watch groups like, not Brambles, but Amcor, and all the input costs going into whether it's energy or paper or pulp, whatever it happens to be, seems to be a lot of pressure at the moment. So I know nothing about it, so I can't really...
Well, yeah, one of the reasons that the company has really surged over the last few years is during COVID, these guys got absolutely whacked, obviously printing and what have you, out of home type stuff. But there's been a massive multiple expansion. It fell to 2 or 3 times earnings during COVID.
Yeah.
Now it's back up to around 10 times, and it's hovered around 8 historically. So really interesting. I did notice, I believe some of the directors had sold some shares recently that's, for me, that's not necessarily a red flag. I know it is amongst a lot of investors. For me, it's more like an amber coloured flag. So what I would say is just, I don't know enough about it to have an informed view, but it's definitely one for the watch list, just given the quality metrics. Like, I look there at profitability, cash flows, margins, because typically in a capital intensive business, you see those lower margins. So something to keep in mind. The next question comes from Tassie Tiger. Very animated, it seems, from this short message. The next Pro Medicus, ! I believe Seer Medical will be a successful global healthcare company soon. If you could buy it now through Series A or B funding, would you? ? Thanks, Tassie Tiger. Good question. I'd buy anything if it was the next Pro Medicus. Obviously, Pro Medicus up thousands of % over the past 10 years. Tassie, this is I don't know if it is doing Series A or Series B.
There was one on the NASDAQ. Was that?
No, it's not this. That's Seer Inc.
Ah, all right.
Yeah. I couldn't find much about this business.
Is this the ECG? At-home ECG? Is that what
this
you
is?
found?
No, I don't know. I was just trying to look for... yes, it is, actually.
Yeah.
But I was trying to find any sort of like financials on it, and I couldn't. I don't know if it is doing a Series A or Series B. Did you want to explain what Series A and Series B is?
So like early funding rounds for private companies. If you probably start at if you think about an angel investor stage where you get if you're starting a company, you've got technology or a product, you go to your friends and family first, or these kind of angel investors who are investing in a lot of different startups. And then Series A is kind of your first big raise where you're starting to prove up your product.
Yep.
And then Series B is just the follow-up after that, essentially. Putting the sunglasses on. And that's, this is all pre-market, pre-profitability usually, and then I can see myself in the glasses. And then it grows from there. And then you go Series A, Series B, and then probably a bigger raise, and then a pre-IPO, and then an IPO is how it would usually go if you're still growing at the right rate.
Yeah. So basically what Drew's saying there is like, this is early stage.
Yeah.
Series A, Series B. And the reality is a lot of companies don't make it through to pre-IPO. A lot of companies don't
make it past Series A.
Yeah, Series A, particularly in the medical space. So the things that I would be looking at if I was looking at a business like this, and we've got a couple of questions on this, is just, revenue. Is the company revenue positive, basically, if you're that early? Because the earlier you are, obviously, we were talking to some venture capitalists here last night, and they were saying, like, a lot of these companies are ideas. Or they're just people with ideas. They haven't actually done anything. So there's no MVP, there's no minimum viable product.
Yeah.
And they're investing at that stage. And the further you go down that kind of company, I guess, journey, the newer it is, the less kind of like rigorous your fundamental research becomes, and more what are the people about? Who are the people that are involved? So
definitely,
those are the types of things that I'd be asking. Is it revenue positive? If it is, how are they managing costs? How is the alignment, etc.? I've actually got an interview coming up with Matt Vitale on the Australian Business Podcast, which you might find interesting, Tassie Tiger. Matt Vitale is the co-founder of Virtual, which we mentioned
a couple of weeks ago.
A couple of weeks ago. Virtual is the crowdfunding platform that specializes in helping investors get into private companies, small private companies. So that'd be really interesting. If you want to join for that one, Tassie Tiger, it's the Australian Business Podcast. It's the green one from Rask. Go and check that out. If this is the next PME and you've called it, Tassie Tiger, you are on record. So
is it a product or is it a software? It looks like a product.
It looks like a product, yeah.
You can see it's like a radar in your room.
Yeah, home video EEG.
Yeah.
Gold standard diagnostics, no hospital visits.
Which seems challenging. If you're creating a product, that seems challenging when you're working against some of the biggest healthcare companies in the world, if you think about it.
It does. But if you can execute, then you're a straight up acquisition target, right?
They'll just take you out straight away.
Yeah. So you can, someone like, Fisher and Paykel, Phillips, something like that, will just see it and just be like, thank you.
I think it's a natural, most GPs or, hospitals, emergency, run off their feet at the moment. So the more of this at-home kind of care and, ability to track important, all kinds of monitoring, surely there's a market for it. I think was one of the books I read recently talked about, people try to get the biggest possible market or biggest total addressable market and have a small share of it. You more likely want to do what they're trying to do, which is own a very small part of the market and be very good at it, know exactly what it is. Yeah,
absolutely. There's the book Value Investing. Who is it by? Greenwald and Sonkin. That book talks about some of the businesses that dominate niche markets and how valuable they are. They may not be gorillas of like massive TAMs, but they're like gorillas in their big fish in their little ponds, and they are so profitable. And so, yeah, I mean, if you can get on them early, that's fantastic. Like one of those companies that I always refer to is WD-40, the 1,001 uses, that spray.
Yeah.
That's a company, over the last 5 years, it's up 55%, but it is a company that since 1983, it is up 2,100% with dividends along the way. This is a company, and this is, I don't know,
one product
split adjusted. It just does WD-40. So it's got a few other little things around it, but that's, WD-40 is like the thing that's known for. And $2.4 billion company, it hasn't gone and trying to be.
That's the other challenge of being on the ASX is shareholders in the market constantly wants you to grow by doing something.
Yep.
Whereas sometimes you just consolidate and run a good business.
Yeah.
And return capital to shareholders.
Drew, we might play a bit of quick fire in the interest of time here. I'll ask this. Lucky Phil asks, better buy Pendle or Perpetual? And I think that he's talking about the shares here.
Neither.
Okay. So Pendle is a fund manager.
Well, we know we got burnt by Magellan. So
yeah, that's it. Drew is scarred. PTSD, and these both start with P. So there is it rhymes.
Too many reminders.
Yeah. So
I mean, they're in the middle of the kind of takeover bid at the moment, aren't they? Or is it going ahead? I can't remember exactly. I mean, they're clearly trying to get scale. I think it's 100 billion plus managers together, but investment management. It seems like the proliferation of passive, how popular ETFs are, and a lot of the fees on a lot of the active strategies are still quite high. They haven't come down. I know, not recommending it, but we've used the GQG.
Yeah, GQG
strategies. They're listed on the ASX as well.
Yep.
And their fee is significantly lower than everyone else. So it's kind of feels like everyone's going to have to reduce at some point. Whether that happens or not is another story. So that's a question of, are your margins sustainable? Same problem that Magellan's going through at the moment.
And Platinum's probably the one that's stuck to its knitting and hasn't really moved, but its share price has just slowly dwindled.
Yeah.
And flows too have been following suit.
Even when they perform well, they can't get the share price up.
Yeah, if you like this, Lucky Phil, I'd probably look at something like Pinnacle, PNI is the ticker symbol, or GQG, as Drew suggested. It basically comes down to flows and fees.
Yeah.
How much money can you get in? How much can you charge? Because a lot of them with their performance hasn't been, particularly with like Perpetual over the years, hasn't been super impressive. So they're not earning those massive, massive performance fees like Magellan did for all those years.
Yeah.
Living the dream, Rookie Investor. It says, if using personal bank account, e.g. CommSec NabTrade to invest, do I still need a share registry account for them to track my tax file number, or will it be given to them by my bank? Similarly, if I am trading through a super account, will they provide my details to the share registry? I'll answer the first one. You still need your share registry account. CommSec or NabTrade may send your tax file number through to the share registry.
Should.
But just go and check it, because it's so easy. You can log in using your holder identification number, which is available inside CommSec. I think it's on the portfolio tab. It's kind of like hidden there. Use that, log into Computershare, log into Link, create yourself an account, put your tax file number in, put your information in, opt for not paper statements, but digital, like email preferences, and set up your DRP, your dividend reinvestment plan from there. Computershare and Link are kind of like...
Computershare, Link, Boardroom, Automic.
Yeah.
There's a few more as well. That's the challenge, that you have 5 different logins for these things. So we've found we use the advisor-initiated platforms, and they all update the TFN for you and the bank account for each investment only when you buy it. So if you're transferring something in, then you need to be careful and make sure it's updated. Yeah, so just go in, just do it, because it's so you don't get to choose the share registry. Just an FYI, if you are a new investor, you don't get to choose. The company chooses the share registry, or the ETF provider chooses it. So like all of BetaShares ETFs are Link Market Services, for example. Yeah.
So if you own a BetaShares ETF, you'll have to get a Link Market Services account to put all your information in. I'm not sure about the super, but that's probably more an account. That's probably
It'll be the same as well.
It'll be the same thing.
If it's through a wrap or something, it'll be all organised.
Or something like that. Yeah.
Then it'll depend on your broker, but most brokers these days are set up for all new purchases to just pass it straight onto the registry.
Yeah. Next question. It's a statement from Fiorella. I would like to sponsor the podcast. Well, that's great. Fiorella, can you please send us an email to service@rask.com.au? We do have a lot of sponsors on the show, and we're so grateful to Self-Wealth, InvestSmart, and soon, I think I can say this, we'll have JP Morgan. So thank you, JP Morgan, for joining us. So wonderful to have you with us. Next question comes from Anonymous, because didn't put a name into this section. I thought it was mandatory, but okay. How can I get into the US shares reinvestment schemes? I think they're talking about like dividend DRP, dividend reinvestment plans. I'm considering making my first US share buy in a technology company. I love Apple, don't we all? But not sure about A, reinvestment, B, franking credits, and doesn't matter if it's broker/direct owner. So a few things in this. One, you won't get franking credits because it's a US company. It has to be an Australian tax-paying company to get franking credits.
Correct, yep.
And the other thing is a lot of the brokers don't offer DRPs or reinvestment, so you have to take your dividend as cash.
Because technically it's not like you have a HIN like in Australia.
Yeah.
You almost share a HIN overseas because they have a custodian that handles all that. So obviously if 1,000 different investors wanted to DRP, how do you split up the units on the other end and deal with the tax?
Yeah. So in Australia, there's a slight difference. As Drew was saying, you are individually identified as the investor who owns a particular share.
Yeah.
Whereas in the US, you're all bundled together.
And particularly the platforms that are investing overseas from Australia.
Yeah, those ones. I think there are some platforms in the US which probably could offer this. But for the most part, you can just get the cash dividends and reinvest them. If you are going to invest in US shares, just remember to fill out that W8 Ben form, as Drew just mentioned. That minimizes your withholding tax.
Yeah, definitely.
Yeah, you got to fill it out, I think, every 3 years. Is it 3 years?
And I'm sure most of these platforms you could set an automatic trade anyway if you wanted to buy more Apple on a quarterly basis. I think we've talked in the past though about not having too small. Like if you're doing, don't do $100 trade or build it up. Otherwise, you're just going to get eaten up by transaction costs all the time.
Yep. So great question. This is a long one from Cassie, long-time Rask member. Lots of feedback here. So there was one question, VAS or VHY? For a near 50-year-old, this is strictly hypothetical, Cassie, thanks for sending it through, which would be a better pick? I feel like I'm 40.
I feel like I'm 28.
I'm still 21. Actually, people tell me I'm 12. Look at the shirt. So, Drew, we've spoken about this. So, Cassie goes on to say, from podcasts, I get the feeling VAS is first choice for the general community. However, recently you and Drew mentioned if nearing retirement, VHY may be better for dividend income. Which would you tell your older cousin to go with?
Tough question. I think it probably depends on the rest of your portfolio is probably relevant as well.
Yep.
And I'd say, as we've talked about, the VAS ASX 300 tracking, that's like your low-cost core, get exposure to everything. VHY would be more of a tactical tilt towards high dividend-paying stocks because it's always going to buy the highest dividend payers from the last 6 or 12 months. So at the moment, there's a lot of resources in there and energy, whereas before there would have been a lot of banks. So honestly, I'd be using both. I don't think one precludes or excludes the other. And you run the risk of having too much exposure to those momentum or higher income sectors as they potentially roll off as well. So,
good point. So VAS is Vanguard Australian Shares, 300 shares, there, give or take.
Yep.
VAS is anywhere between 60 and 80, depending on when it rebalances.
Yep.
And it focuses on companies with forecast dividends.
Yep.
Both
VHY.
From Vanguard. Yeah, VHY, sorry. Yep. So you're going to get more yield because you're selecting dividend-paying stocks with VHY.
Just get the risk that you get more in income than potential growth.
But as you were saying a little while ago, a lot of your clients are retirees who are in that kind of like neutral, low tax environment, which makes sense to harvest as many franking credits as you can.
3 to 4% frank, definitely.
Whereas VAS, which is the regular one, it's like typically a 4% yield. or thereabouts, you're probably going to get more growth like from those businesses.
Yeah, and you've got some mid caps in there.
Yeah.
Much more concentrated in VHY as well.
And so overall basket size is what Drew's trying to say here is think about them as basically one exposure, but you're just pushing one towards this particular type of company.
Yeah, definitely.
So that wouldn't be like you're not diversified if you have VHY and VAS and that's all you got.
Yeah.
But I think, Drew, like one of the concerns that we get in the Rask community, in the core community, is people are getting to that stage where they say 50 to 60, they'd like to retire in 10 years. They know that if they sell VAS, they're going to incur tax.
Yeah.
And it's probably a big position for them. They don't want to sell it. So what do they do there? If they want to focus on that yield in retirement, do they just slowly take the dividends from VAS and slowly reinvest them back into VHY? Was that what you'd do?
Depends where you're holding it. If you're close to retirement.
Personal account, say.
Yeah. Just wait it out until you retire and your tax bill goes down.
True.
I mean, we'd be, the way we always view portfolios is try to review them quarterly and slowly rebalance. So there's no need just because you retire to get your portfolio exactly where it needs to be overnight.
Yep.
We've got most clients we talk to will do it over 3, 4, 5 years where you don't want to realizing capital gains is, that money's gone straight to the tax department. You can control it as much as possible. So I'd always build it up over time. Make sure you're not reinvesting if that's you're seeking to add diversification, and then introduce multiple other things on the way through.
Yeah, I like it. Yeah, I think both are great ETFs, to be honest. So one you can tilt towards if you want more income. If you're a high income earner, obviously you want to avoid crystallizing any tax, whether that's income or capital gains, while you can. Cassie does go on to say that I enjoy your podcast with Drew. You two are very comfortable and natural together. Fun banter makes my cycle to work enjoyable. Let's be careful on that bike there, Cassie.
Too comfortable sometimes, I think.
Too comfortable. So if you have any more questions, Cassie, please send them through.
There was this, presently VAS yield is above VHY.
Oh, yes. Oh, yes. So she said, sorry, yes.
I think that's just because of BHP.
Probably.
Like BHP just paid, and Fortescue.
It could also be, she might also be quoting distributed capital gains.
Yep.
So when you see the yield on the ETFs, I'll just quickly
Comsec,
get this. Yeah. And when you see the yield on some ETFs, it looks like it's a lot higher than it actually is because of the, some of the websites report total distributions, and total distributions can actually include capital gains. So just keep that in mind. What you want to look at, if you go to the Vanguard website in this instance, they actually quote something called equity yield. It sounds a bit weird, but it's their estimate of what the dividends are. And that's probably the way. So the equity yield on, what's this? This is VHY. Equity yield is around about 5.8% forecast. For VAS, it is 4.4%. So that's the true thing that you should be looking at. Like if you go to some of the providers' websites, like I think this is, BetaShares is trying to do a better job of it, but it looks like the yield's really high, but it's actually just distributed capital gains.
That's the unique thing about trusts and ETFs. ETFs are unit trusts, so they have to distribute all profit every year. That's why you get this big lump in July if it's been a strong year for the market, because it's capital gains and income.
Yep.
But everyone just views it as being income, even if it reduces the capital value.
And that's why some of those yield harvesting ETFs are rubbish.
Yeah.
Because they...
Strong words.
It's
a little bit early.
Oh, geez, I'm just going to put my head down now. So, did I just say that? No, but it's true. Like some of them, if you look at it, like it's okay, they do their job. In retirement, zero tax environment, if
you know what you're getting.
You know what you're doing.
I don't think everyone that buys them knows what they're buying.
Yeah, if you buy one of these ETFs and you think, it's got 10% yield, that's great. That's probably not going to be sustainable. So where is it coming from? Yeah. It's coming from your share price falling over time.
You're buying a depreciating asset. Yeah. Essentially, it's being sold partially every month.
And rubbish was very strong. For those in retirement, that could work because you harvest franking credit.
Can you hear that shovel?
I'm digging. Okay, let's move on to the next question.
Going deeper.
Okay. 3 more questions. Miss ETF. For long-term international share exposure, how would you compare the more concentrated IOO ETF with the more diverse VGS ETF? Well, I can tell you straight away, yeah, you're right. It's concentration. That's what it's all about. IOO, I think, is 0.4% in fees. VGS is a lot lower.
It's iShares 100 versus an MSCI tracking all world. That's what the VGS is.
Yep.
I think we kind of see the way we build portfolios for most people is a core satellite. So you get a really low cost core that gives you a big market exposure. Investments is one of the only markets in the world where you get, I'm quoting this from somewhere else, you get I can't remember who it wasn't Animal Spirits, where you get average for free. So like you can buy the average for market. Essentially, you're paying 4 basis points for the average. What other industry do you get the average for free? You either pay more than you need to, or you're the product and you get charged and don't know about it. Yeah. I think I kind of like both and have used both. The MSCI is the global benchmark. That makes sense as your core. And then your IOO, the VGS is always going to have about 65% in the US, not much exposure to Europe or Asia or anywhere else, whereas the iShares 100, I know it's still US focused, but it introduced a lot of big European, healthcare, consumer staples, a lot of those sectors that aren't as prevalent in the US and offers some pretty good diversification. So I'd see boring old core in VGS and a bit of a global diversifier in IOO.
I like that, yeah. Some people in the past have said, some experts have said that you go with IOO for the liquidity because it's a very liquid ETF.
iShares is bigger.
Yeah, because you get the top 100, which is very easy to trade. To be honest, I think we're past that now as an industry.
Yeah. Well, we've gone through a couple of crises and there was no problem with volume or quantity, even in the bonds, which you'd think are less liquid than equities.
We did have a few issues in the GFC though with bond ETFs.
Yeah.
But other than that, since then it's been pretty
2020 was...
It's fine.
I think it was like commodities that were the biggest struggle.
Yeah. So as Drew said, IOO has 74% in the US. And I think for the VGS ETF, it's 71%.
Yep.
You've got so many more holdings in the VGS ETF. You've got about 1,500 versus 100 from IOO. I like, as Drew said, I like VGS for low costs over IOO. But to be honest, I also like, for my core, the IVV ETF, which is what we've spoken about.
Straight S&P 500.
Straight S&P 500. Good regime in the US from a regulatory perspective, from a governance perspective.
Yeah.
You also, about 30% of revenue from S&P 500 companies comes from outside the United States.
Yeah.
So as globalization has taken over, a lot of these US companies, like we use Apple products, right? So
everywhere.
Yeah. So you get global exposure through the revenue, not necessarily through the company headquarters, if that makes sense. So I think all three of those ETFs, IO, VGS, IVV, all pretty solid ETFs. They've been around for a while. And
you're talking about real core ones. And whether you want to take that active view of getting a broader range of global companies, and your weightings will obviously be different with 100 companies versus 1,500. But you're not talking about questionable non-core investments. They'd happily sit in any portfolio.
Yeah, agreed. Second last question: ETF and fun, which follows Miss ETF. I wonder if they're related.
Is that a copy of Boat and Camping?
I feel like BCF. Yeah.
I like it.
It rolls off the tongue. ETF and fun.
Clearly on our level.
Yeah. Are equal weighted ETFs that track the ASX 200, 300 or S&P 500 worth getting to diversify across industries in a portfolio?
We, as I probably said before, the way we build portfolios is to try to invest for multiple outcomes. The challenge with building an Aussie core portfolio is that if you just buy the index, you get 50% in 2 sectors.
Yep.
So we kind of like MVW. That's in our ETF model. Because there's a few, things to watch out for with it. But whilst I think we talked about it before, whilst the sector exposure isn't that much different, the number of companies and the type of companies is very different. So the materials I think are still the highest weighting, like they are in the ASX or the banking sector in the ASX 200. But the companies that make that up, you've got some of the lithium companies are in there, the Linuses and these kind of groups, because it's I think every holding is between 1% and 2%. Versus the benchmark where BHP is 10 and CBA 7. So we like it. It's part of our core. Offers, as you said, diversification of sectors and individual companies.
And for the US, if you do go equal weight in the S&P 500, it does change that sector weighting considerably.
A lot more than definitely.
Because you skew away from communication/IT basically. So your Googles, your Apples, your Microsofts, that is all equal weighted. So that pushes way out. So you do get more of exposure to every other sector, basically, at the expense of IT.
Yeah.
But here in Australia, if you do the equal weight, it's very similar. You still got banking, you still got resources. You just got like you said, the spread of companies is different.
Yeah. And the attribution, because everything's 1 or 2%.
Yeah. I would say, it's interesting because one of the reasons that people don't like straight vanilla index funds like VAS, A200, etc., is because we talked about this off air.
Yeah.
The momentum shift. So people think that index funds are momentum driven, but it's actually momentum by sector, as far as I can tell.
Yeah.
So you're moving more into sectors, not necessarily individual companies on valuation.
Yeah.
Which is interesting. So people are like, it's all the stock market over the past 30 years is momentum driven. And you're like, yeah, but it's not just like one thing that's happened this whole time. It's a constant shuffle of those companies.
Yeah.
So do you lose some of that upside by going equal weight?
Yeah, I think it's almost the anti-momentum. Whereas one of the selling points they have is that you're always, because you're always equal weighted or semi-equal weighted, you're always selling the winners and buying more of the losers.
Yeah.
And as I've learnt, don't buy the losers. But it does add some level of discipline. So that's the risk, that you're not allowing the momentum of the market to run and you're missing out on it.
Yeah.
But that's what, if you want if you need diversification, we think, in drawdown and retirees, you do need that diversification to smooth the journey a bit.
Yeah. Do you use, just backtrack. Equal weight means that every company in the portfolio has the same weight at the rebalance date.
Yeah.
So if there's 10 positions, it's 10%. Whereas market cap, which is traditional
size,
index,
just based on size.
Just the size of the company. The biggest one gets the biggest share, et cetera.
Which is counterintuitive when you think about it.
Yeah. It's better than in bond markets, though, where it's like based on total debt.
The most geared company gets the most money.
So then do you blend the MVW equal weight ETF, this is from Van Eck, with other equity ETFs? Is that like
so
VAS?
It depends on the client, sometimes VHY.
Okay.
And VAS or IOZ. I think it's IOZ.
Yeah, iShares.
The ASX 200.
200, yeah.
Yeah. And then you blend it with an equal weight. And then we've got pretty good systems that we use that can tell you where your ultimate sector bias sits and what factors you're exposed to as well. That's important to know if you're adding more cyclical in your portfolio via MVW, or how exposed are you to those cyclical sectors. Yeah,
cool. I like it. Good question, ETF in fund. You can take that on multiple levels. I haven't used the MVW ETF, but could do. There are many different ways to slice it. Investing Questor. Good question. Investing Questor. That's the name, sorry, not the question. So when looking at a fallen stock price of a SaaS company, what company metrics do you prioritize to see if it's cheap due to the market?
None.
Or if it is rightfully down? Drew.
None.
Drew is
None.
Drew.
Knife?
Falling knife. No, well, SaaS company. So let's just break this apart. SaaS company is a software as a service company, like a cloud company. Zero.
A lot of companies claim to be SaaS without being SaaS.
Actually being SaaS.
Yeah.
The difference between software and SaaS is pretty key. Like software can be anything. It can be sold anyway. Perpetual licensing. It can be on contract, like $100 a month. But SaaS companies have the ability to increase prices retrospectively across every user.
Like Adobe or
Adobe.
Microsoft.
Yeah.
They're perfect examples.
Yeah. So if you joined Microsoft in 1999 for $10 a month, your fees would have increased each and every month. That's an example of them. Like that's pretty much a SaaS business model in action. And the benefit of these businesses is that they're sticky. They have high margins because they're software. But they also have downsides in that they're extremely expensive companies to own at times because they are such high quality.
That's where the price to sales ratio became popular in 2020.
Yeah.
And that's probably what you're referring to. How do you value a tech company? It used to be price to sales, but most people would say price to sales is irrelevant if you're not making cash.
In a high interest rate environment, you want companies to prioritize cash flow.
Yeah.
So they're not burning through and then diluting each other, diluting you as a shareholder. One of the things that you can do investing Questor is you can actually look at a company through a life cycle lens. So early days when it's scaling, you can't use the price earnings ratio. You can't use a discounted cash flow analysis. So how are you going to value? You're probably going to use sales. if you're a venture capitalist, you're not going to go, what's your PE ratio? Because they're not even thinking about E's. Like, they're not even thinking about the earnings. They're years away from that. So you have to have a model that you apply to that. Then as the company reaches the tipping point and crosses the chasm, it's a proven product, it's earning revenue, it's probably spending a lot still as it's scaling, then you can start to look at things like, okay, what's the gross profit margin? What is your revenue growth? You can start to move further down the income statement. Then as they actually hit an inflection point and they're profitable, okay, the price earnings ratio maybe starts to factor in, but you're probably looking at discounted cash flow analysis at that point. Finally, when the company matures, sorry, Drew, you get to it's stable in its earnings. It's probably not growing as fast and its profits are stable. That's when...
And then it starts pivoting.
Then it starts to think, well, how do we keep growing? But that's when you start to get to the... price earnings ratio level. So as the company goes on that journey, you should adopt different methods. I always like to default to a discounted cash flow analysis, even though it's got so many shortfalls. I know that. It can be like the Hubble telescope. 1 minute you're looking at Saturn, next minute you're looking at Jupiter if you change one input. So just keep it in mind that there's going to be different tools for different times. For SaaS companies, I value 0 on a discounted cash flow analysis basis.
Yeah. I think I don't even think, if you're buying SaaS at the moment, pretty much everything's down 75%. This is going to sound crazy, but I don't think valuation matters. Yeah. I think quality of product and position in the market and growth. Yeah. A lot of companies that were, 80% more valuable or 200% more valuable, they're 200% more valuable now than they were, but their share price is down 80%. So the key is going to be the product and whether it is truly going to be a winner in its market. Because I'm sure, Aussie bond yields are starting to fall. I'm sure the US I could be proven completely wrong, but it's going to be all about the product and if there's any growth. And most of it, if you're already down 75, 80% on a lot of this sector, I don't think valuation, whether it truly reflects that business at the moment.
Yeah, there's a lot of negative sentiment.
Yeah.
The growthier the company, the more prone it is to swings in sentiment.
Yeah.
And the way to measure swings in sentiment is just to pick a multiple. So it could be, if it's got earnings, you could use price to earnings over time. So if it's got sales, it's price to sales. And you can see, if you can map that over time, the price to sales ratio, you can see moments of compression where the price to sales ratio falls and then it goes up again. Like, that's expectations. That's the sentiment of investors. And right now, as Drew's pointing out, sentiment is very low.
Yeah. Never seen lower price to sales.
Yeah. So I would agree, and I think your comment about product is most important, because if you look at, say, something like Zoom has been absolutely walloped.
Yeah.
It's got like 30% of its market cap in cash, but the problem is Zoom isn't the Zoom that it was 3 years ago, where that's the only thing that people use. Now you've got Teams, now you've got Google Meet, now you've got Apple FaceTime moving, like
ultra competitive.
And so the competitive advantage, that time advantage that it has changed.
Yeah.
So what I would say to you is just look at the business through the lens of product, then look at it over a 5-year view. Can it survive to that point and keep growing? That's what I say. Good question. Drew Meredith, if people want to find out where to get in contact with you and your financial planning services right around Australia, where do they go?
I'm not on Twitter.
Can you get on Twitter? Or is it just like, were you banned or something?
No, I probably should, but I think I'd probably just tweet too much and
Jamie's on
annoy
it,
people.
Isn't he?
Doesn't tweet though.
Yeah, he just
I watch
lurks.
what everyone else tweet. He's a lurker.
Okay, so wattlepartners.com.au.
Yeah, we'll be updating our website soon. It needs a few updates. Email me straight through, drew@wattlepartners.com.au.
Always dangerous.
LinkedIn. Yep. DM me on Instagram. Wherever you want.
Yeah, cool. I like it. Beware imitators. Drew's going famous at the moment, so there could be some imposters.
I saw another one of yours. I still haven't had that, so I haven't had to put the warnings out.
Yeah, it's such a pain, honestly. It almost makes me want to get off a lot of the social platforms because. So just to be clear, it's Owen Rask AU on Instagram and Owen Rask on Twitter.
Not Owen Rask.
And there's no Rask. There's no 00. There's no underscore.
No crypto.
No crypto. If I'm not DMing you about crypto, you can guarantee that.
DMing me about anything.
Yeah. You would be the one DMing me. But I'd love to hear from you anyway, so send in your questions. There's a big button on the Rask websites, any of them, that says ask a question. Select the Australian Investors Podcast if you want Drew and I to answer that. We'll be back probably next week. Thanks for listening to this episode of the Australian Investors Podcast, 2 Cents, with Drew Meredith and myself, Owen Rask. Drew, thanks for joining me.
Thanks again.